Welcome back, guys. Today we're going to analyze Charter Communications because somebody wanted me to analyze this stock. And why do you guys want me to analyze such garbage companies? But okay, anyways, I don't like this company very much, and you'll see why. 5-year chart, they are down to 262. They're minus 25% in the past 5 years. They got all the way up to $807 a share at the peak in 2021, which is insane, especially because this business kind of sucks. But but yeah, the all-time chart looks really really good. But if you dig into their financials a little bit, you'll figure out that it's actually not the best. Okay, it is a $42 billion company. Its price to earnings is 9, so actually really really low price to earnings. So hey, great company, right? Well, let's dig into it a little bit further. Checking out their financials here, let's check out their revenue. Well, look at that. They grew by about 4 or 5% in the past. Well, okay, they grew 43% in 2017, but then it's been like 5% ever since then. And in the past year, they grew 1%. And in the past few quarters, they haven't grown at all. So amazing revenue. Yeah, not really. But I'm not really sure how they got up to $800 a share in 2021. Literally makes no sense to me. In terms of their gross profit, it actually translates really well into their gross profit. And then you've got operating expenses, and after that, you're looking at an operating income of 20%, which is pretty high. But then you also have their interest expense, which they have a pretty high interest expense at 5 billion. So yeah, got to pay that every single quarter, every single year. And yeah, pre-tax income, it translates about what is that, like 12%? But then after your taxes and whatnot, you're looking at about an 8% margin. So I mean, 8% margin is okay, I guess. At least it's a margin. So we'll give them that. But this is the problem with this business right here. Net debt of 98 billion and the market cap is 43 billion. So they have a lot of debt. They have twice as much debt as their entire market cap. Not good to see, especially when you figure out what they're doing with their cash. Um, yeah, in the past, okay, look at their net debt, how it just grows and grows and grows. And cash flow, when you look at their cash, they are buying back all of their stock. And especially in 2021, they bought back $15 billion worth of stock at $800 a share. Doesn't really seem like the smartest thing in the world to do, especially when you have about $100 billion worth of debt to pay off. Yeah, it doesn't make any sense to me why management does this, but they decide to do it. It's probably so that they can get their bonuses. But yeah, that's one thing that I had to rant about for this company. Yeah, they were even taking out debt and then buying back stock. Like, why? Why can't you just pay, like, use that cash instead of? It just doesn't. I just, it's annoying to see stuff like that. Let's check out their stats really quick. Looking at their margins at least. Their ROIC is abysmally low at like 4%, so not good to see there. Gross margin at about 40% and net margin at about 8%. Yeah, I'd say between like 7 to 9%. I actually found some of their investor slides, so we're going to take a look at these. Shares outstanding. As exchanged partnership units. Okay, so there's going to be some extra shares coming out pretty soon, and a lot of them. So maybe that's why they have to buy back so many shares, because they give so many to their holding partners. I'm not quite sure what that means actually, but checking out their debt maturities, they've actually got a lot of debt maturing in 2027. And yeah, I mean, they've got a lot of debt that's like far out as well. It's like mostly fixed rate, and it's like 5.3% interest rate. So not that high. It's definitely manageable at least. So that's one good thing, except they do have a lot of debt maturing pretty soon here. And if they have to roll that into higher interest rates, that is not going to be good for them. Not going to be good for their margins at all. Could possibly, I don't know, it could possibly send their margins negative if they have to refinance all this debt at a higher interest rate. I don't know, that could be bad news. But yeah, let's check out their next slide. This is their capital expenditures. So they had to spend a bunch of money on line extensions for lines that they're running in rural communities. And they expect that to kind of fall off a little bit. So if they stop spending so much on CapEx, then their free cash flow will improve. And they should be able to buy back more stock because that's what they seem to like to do. And in terms of customers, their customers are declining by 0.2%. That's year over year. And yeah, so it's not growing at all. In terms of their customer base, they lost internet customers, even though they're trying to expand their internet lines. So that actually doesn't make any sense to me. They're expanding their lines, but they're losing internet customers. In terms of video customers, they're losing a lot there. That makes sense because nobody likes cable TV or satellite TV anymore. Most people are just going to streaming. Voice, not quite sure what voice and mobile lines is, but they actually gained in mobile lines. I don't know. Yeah, so I think it's it's not growing, that's for sure, and it could possibly be declining. In terms of analyst estimates, let's check. Well, actually, let's check out the yeah, market beat. Let's check market beat. Oh yeah, right here. 11.6% of the shares are sold short. That's very high short interest, and usually short, like people that go short a stock, know what they're doing. So that's not a good sign. And we could check out insider trades as well. Nothing like too well. Actually, okay. A chairman sold like $70 million worth in Q4 of 2023, so pretty recently. Sold quite a bit, and the insiders will only own like not even 1% of the business, which isn't very high. Let's check out the analyst estimates here. 33.9 earnings per share for next year, and then after that, 36. 55 billion going up to 55 billion, basically not growing in revenue at all. I plugged this stuff into my DCF model. So remember, Charter actually has a pretty low price to earnings ratio, which is good. And so we're seeing a fair share price pretty high at $338. And with their current price at 262, then they would be a buy according to that. But if you factor in their debt, and considering that you do have to pay off debt at some point, then if they had to pay back all their debt today, they'd be negative $268. Or that's how much the company would be worth. In reality, their fair share price is somewhere in between this. Probably I would put them at like I don't even know. They are servicing their debt like pretty well right now, but that could change in the future. Like who knows? It really makes it a risky business with all that debt. I'd probably put them around like 150. Like I'm just not touching the stock if you couldn't tell. But yeah, and even with the revenue model, we're expecting revenue growth of 3%, profit margin of 8%. That's what they've historically done. Maybe if they stop spending so much on CapEx, they could get this profit margin up a little bit higher. But also they have a lot of debt and they have to keep paying that interest expense. So I don't know. If this case plays out, they're worth $315 a share, and if you account for their debts, then they're negative $291 a share. Probably I'd put them at like 150, like right in between those. So yeah, definitely not touching the stock. I hope you guys enjoyed the video. If you did, hit that like button. Also, leave a comment in the comment section for any other garbage stocks you want me to analyze. And yeah, I also left a link in the description. If you guys want to try out this model for yourself, just change the yellow boxes and it should give you some pretty accurate results. So yeah, I'll see you in the next video.